Well, now the BBC's business editor Robert Peston investigates the murky world of financial algorithms in A Dark Magic.
Think of a trading floor in the city or Wall Street. What springs to mind? Frantic men, ties loose, sweat beading on brows, gesturing and shouting into telephones? Well, that's how it was for decades. No longer.
10 years ago, a desk of equity traders may be between 80 and 100 people at the average investment banks. Today, there's maybe 8 of them left.
In our IT era, computer code, algorithms, not humans, place most of the orders to buy or sell on Wall Street. An estimated 70% of trading decisions on US stock exchanges are made by computers.
One of the most interesting things I've observed is this battle between man and machine. And it's like watching the Terminator movies in the financial markets. We came that close to being wiped out.
The triumph of the machines hasn't only been at investment banks and hedge funds. These days, most financial institutions, including our high street banks and pension funds, rely on algorithmic code. These algorithms are having a powerful influence on your savings, what's in your pension fund. And what may disturb you is that it's like a Terminator movie with competing algorithms clashing with each other and on occasion causing market meltdowns. Algorithms are changing the financial landscape in a technological arms race in which the speediest, trickiest and most secret win everything.
We allow people with faster connections to place and remove offers faster than the speed of light can deliver that information to the other market participants.
"30 years ago, unsure what I wanted to do in life, I worked briefly on the floor of the old London Stock Exchange as what was known as a blue button. This was an era of brokers in top hats and jobbers who thrived on their wits. All gone now, swept away by the arrival of electronic exchanges. Traders have been made redundant by complicated computer programs called Algos, and trading pits have been replaced by huge warehouses with row upon row of computer servers running these programs. Black boxes.
When I first started on Wall Street, all the traders were sort of masters of the universe. They just had an enormous appetite for risk, but not great analytic skills.
10 years ago, John Coates was a trader on Wall Street.
That began to change, under the influence of hedge funds doing, a very different kind of trading to this sort of gut feeling driven, high risk taking. Around early years of the noughties, we became aware that some hedge funds were running these algos and that they were extraordinarily successful. And that's when the development of the black boxes turned into something of an arms race in the financial world.
In a few short years, the fast-living, loads-of-money traders, the totemic masters of the universe derided by the author Tom Wolfe, have been ousted by the so-called quants, the mathematical brain boxes. In a recent article, Tom Wolfe wrote about this takeover of the automatons.
Our manly masters just didn't get it in 2009 when the most unlikely thing in the world happened. A bunch of weaklings, a bunch of nerds known as quants, shut the golden door flat in their faces.
One hedge fund in particular, the ultra-secretive and mind-bogglingly profitable Renaissance Technologies, set up in 1982 by a maths genius, Jamie Simons, is credited with starting the revolution. It took much of the rest of Wall Street 20 years for the penny to drop. But there's been no turning back. Today, it's the quants who rule the markets, the engineers, mathematicians and physicists who program their computers to mimic the behaviour of the best human traders, spotting opportunities to make a quick buck, but doing it far faster than a mere human being. A more familiar nerd is John Coates. He left Wall Street in 2004 to become a neuroscientist at Cambridge University, and he now spends his days monitoring traders' hormones to see what makes them tick.
Humans can't compete on speed. We've been left behind by the boxes. There's simple tests you can do when you see a green light or a red light. You click the mouse. And I think the fastest you can do that is about 120 milliseconds. The trouble is the boxes, the last time I looked, they were processing a trade in about 10 milliseconds. But since then, I think the latencies have gone into the microsecond level. So we're talking millionths of a second here.
Tom Wolfe writing in the Sunday Times, has written about this takeover of the automatons.
Onward, faster, faster. At 1,000, 2,000, 3,000 banking operations, investment funds and exchanges, quants kept adding computers and servers, row above row on floor-to-ceiling racks that stretched on infinitely like the stacks of the biggest library in the world, wrapped in miles of white fiber optic cables that interconnected the machines. Sometimes the drone would rise slightly, then lower, then rise and lower. It made you think this enormous robo-monster was breathing.
The year the machine smashed through the barricades was 2007, when regulators in the US and Europe made it much easier for new electronic marketplaces to compete with the traditional stock exchanges. Suddenly, the 300-year-old London Stock Exchange faced savage cut-price competition, a bit like Marks & Spencer being surrounded by Primark and Poundland. The stock exchanges had to adapt or die, so they moved their operations onto bigger and faster computers to which their customers, the tech-savvy traders, could connect their computers. And as the number of rival electronic exchanges proliferated, there was born a whole new breed of trading firm, the high-frequency traders. These outfits use vast computing power to keep track of prices quoted by those myriad stock markets, and they buy and sell between those markets when the price of a share is different on one market from another. It's like buying a pair of knickers at Primark and then selling it to Marks & Spencer, and all at the speed of light. Few high-frequency trading firms talk about what they do in public. They're obsessed with keeping their strategies and technology clandestine. But Remco Lenterman, who runs IMC in the Netherlands, wants to dispel the mystique and mistrust surrounding firms like his. If I were to come to IMC, what would I see?
You would see banks and banks of computer screens.
With people sitting at the screens?
With people sitting at the screens.
And what are the people actually doing?
What they do is they operate algorithms that are effectively mimicking what traders used to do. And they're tweaking constantly these algorithms and monitoring the risk that is being taken in the markets. It's just like you wouldn't want to fly a plane without a pilot. I mean,
so it's in case something goes wrong.
And in case things go wrong, yes.
And these are all brain boxes who understand about how to program, how to write algorithms, and all the rest of it.
Exactly right. Very, very smart people that have a very different skill set than 10 or 15 years ago.
And do they have to know anything about businesses? Do they have to know anything about BP at all?
No, because
do they have to read the newspapers about BP?
Well, all that's interesting to them is the technicals. Price.
These electronic market makers buy and sell thousands of times quicker than the blink of an eye. If a stock like BP is momentarily priced cheaper on one exchange than another, they swarm in to buy the stock. The important concept is latency, the delay in reacting. Every player is trying to reduce latency to the minimum dictated by the laws of physics, the speed of light. This race to zero is pushing everyone to build bigger and faster computers. That means most trading on Wall Street, home of the New York Stock Exchange, doesn't happen in that famous block of Manhattan real estate, but in unglamorous New Jersey. That's where the New York Stock Exchange has built a vast electronic trading facility covering 10 acres. And many more acres house the servers of the trading firms linked to it. Money is also being thrown at projects to build the fastest possible electronic pipelines between the big trading centres like New York, Chicago and London. Donald Mackenzie is a sociologist at Edinburgh University.
Traditionally, those fibre optic cables have followed the railway lines between New York and Chicago, because that's the easiest place to lay down a fibre optic cable. You've only got one company to negotiate the rights with, and nice and easy to dig at the side of the line. But those train lines, of course, don't go direct. They avoid the mountains and they divert via other cities. So about 3 years ago, a firm called Spread Networks had the idea of laying a new direct cable going straight through the Allegheny Mountains. That shaves just a little bit more than 1,000th of a second off the transmission time between Chicago and New York.
The annual cost of playing as a high-frequency trading firm can be £100 million or so. Firms like Remco's make that back through scraping a tiny profit on an unthinkably huge volume of rapid-fire buying and selling deals. Remco says they're doing the public a service because the gap between buying and selling prices for most of us are narrower than they've ever been. But what matters to investors is not just this so-called spread between what's known as the offer and the bid. If, for example, the pension fund that manages your savings wants to sell a colossal amount of shares in a single company, it doesn't want traders to get wind of its intentions, because if they do, they'll slash their prices so that the pension fund gets the worst possible deal and the trading firms get the best. It's like a game of battleships. The pension fund wants to smuggle its shares onto the market without the super-fast computers of the high-frequency trading firms working out what's happening and blowing up the deal. So big investors have also invested in algorithms to disguise their buying and selling. It's the job of Deutsche Bank's Greg Woods to help his investment clients execute their transactions without being detected.
When your mum and dad or your grandparents ask you what you do, what do you say?
I say that I'm a director for algorithmic execution for listed derivatives and foreign exchange.
At which point they presumably lose the will to live. So what do you say after that?
I help clients trade more effectively on the markets. You have to use the right tools to be able to execute that trade to get the best price. Because one of the things that any trade has is impact in the market. The larger the trade that you have to execute, the larger the impact it can have on the market. What you're trying to do is you're trying to minimize your signal and try and avoid looking mechanical.
So why should you care about algorithms playing battleships in financial cyberspace? Well, the outcome may determine how much you have to retire on. Remco Lenterman.
One of the largest pension fund managers in the world is called Vanguard. They run about $1,000 billion a day. They have calculated that because of the lower transaction costs over the last 15 years, the average pensioner whose money they run will have 30% more in their investment account at the end of the day.
Which is all very well, except that the triumph of the machines hasn't been without the odd accident. For example, in August 2012, the high-tech financial firm Knight Capital was brought to the verge of bankruptcy by an algorithm that went haywire, racking up over $440 million in losses in the space of just 45 minutes before it was switched off. Perhaps the most famous mishap was the now legendary New York flash crash, which occurred at 2:45 on the 6th of May, 2010.
We have some unusual activity, the biggest gimmick that's ever happened on Wall Street.
We can't stop the selling!
Trade here, you're going to get a new
price. Cancel all orders! Cancel all orders!
In the space of just a few short minutes, the New York Stock Exchange plunged and then just as suddenly recovered again. Share prices in some firms, like the consultancy Accenture, plummeted to a fraction above zero, while Apple soared to $100,000. For months afterwards, nobody could explain what had gone wrong. Donald McKenzie says that the robots of the high-frequency trading firms, in effect, panicked. They stopped buying and selling and dumped whatever shares they could.
All across America, the red button was pushed. Firms stopped trading and tried to sell off whatever positions they held. And of course, the consequence of that was a very big, very sudden drop in stock prices and absolutely bizarre movements.
They essentially took on more inventory than they could hold. And at 14, 42, and 44 seconds, a tipping point, at least for one of them, that just turned around and sold all the contracts that they had accumulated.
Eric Hunsader runs a data analysis company called Nanex in the United States. He studied what happened in the flash crash in each of its busy microseconds. Hunsader holds high-frequency trading firms responsible for what the official crash investigation called the hot potato effect.
That sell event, which happened instantaneously, caused the information that Wall Street has to process to peak, and the systems hadn't been upgraded. They couldn't keep up, and that slowly caused information to get delayed, which caused other people to pull out. You ended up having these other HFT firms which absorbed that first one get into the same state.
In other words, one by one, the automated high-frequency traders tried to cut and run, and the stock exchange's computers got swamped. But Remco Lenterman insists that's not the whole story.
The two main US regulators looked into this, and the blame for the flash crash was actually very firmly put at an institution that was trying to sell a very, very large amount of securities in a very short period of time. A very nervous market. There were riots in the street of Greece at the time. They tried to do that in 20 minutes.
So your view would be that high-frequency trading was blameless?
I think everybody is to blame. The fact of the matter was that the cause of it was this one large institutional order.
That large institutional order that Lenterman blames for triggering the crash was one of those trades in this vast and expensive game of cyber battleships. And it was carried out by a computer algorithm. Eventually the market hit bottom and then snapped back. Many investors lost a lot of money that day, but the damage wasn't devastating, although that can perhaps be seen as a lucky escape. Now, to prevent such extreme volatile swings recurring, regulators have introduced circuit breakers. They automatically halt trading when share prices move more than a specified amount. Problem solved? Perhaps not. Eric Hunsader, who spends his days obsessively picking through the undergrowth of stock market data, tried to show me how mini flash crashes are now a way of life.
What we've got here is some multicolour. They look actually like something out of a sort of 1980s computer game of some sort, really. It's got that sort of slightly clunky graphical multicolours, dots and squares everywhere. I'm not sure whether I'm a winner or a loser looking at this, but we're looking at the Google share price between 9:30 on the 22nd of April and 9:47. The Google share price falls really very significantly, doesn't it? It falls and then it bounces back. So what's going on there?
Yeah, so if you skip all the way to the bottom chart here, we'll explode that 1 second of time.
We're seeing all sorts of different exchanges and real transactions. So tell me what's happening in this second.
What's going on here is when speed becomes the paramount determining factor in whether you're profitable or not, then it matters more you getting in first or near the front than at the end, because as long as you have somebody following you, you will always be able to offload your position onto them at some point in the future. So the algos are all primed. They only see what other algos are doing, and if other algos are herding into one direction, a stampede, if you will, they're going to want to join that stampede.
Now, are these spikes upwards and these sharp drops downwards, have they become more frequent since high-frequency trading?
They didn't exist before this.
So it's fair to say, in your view, that high-frequency trading has created volatility. Is that correct?
It has.
Now, are individuals behind these firms making a lot of money out of these movements?
Yes.
Because they are turning a profit here?
Absolutely.
How often do these mini crashes happen?
Oh, there's dozens every day.
Hunsader alleges that high-frequency trading firms aren't just dealing for investors in a passive way, but they're trying to manipulate prices for their own benefit, using a variety of strategies, one of which is called spoofing. Trader-turned-physiologist John Coates explains how electronic traders spoof, that's pretending to be interested in buying or selling, to flush out the intentions of rivals.
The boxes do what's called painting pictures on the screen. Let's say ExxonMobil was trading at a price of 100 at 101, and you will see that on the screen. But then if below that, they put in bids showing, someone wants to buy 1 billion of this stock, 2 ticks below the market, it looks like, holy smokes, there's lots of buying interest in this stock. But it might just be an illusion, because if you get anywhere near that price, they just kill that bid.
Eric Hunsader elucidates.
We allow people with faster connections to place and remove bids faster than the speed of light can deliver that information to the other market participants.
You're saying these orders are placed and removed faster than the speed of light.
They are removed at the speed of light.
Right.
But the speed of light means that by the time that information travels to the other market participants, it's already over. For example, you and I are separated by 50 milliseconds of time. When I speak, the fastest you can hear it is 50 milliseconds later.
So what you're basically saying is the offers are made and cancelled before they get to either the buyer or the seller.
Correct.
Then there's quote stuffing, when firms generate vast amounts of electronic traffic with the intent of slowing down the exchange's computers.
In the peak 1 second of trading today is equivalent to the amount of information we had just 10 years ago over the entire day.
That's astonishing. And how much of that is phony trading?
It's almost all. We haven't had real growth in actual trading for several years now.
With the huge amount of data whizzing through the wires, it's enormously difficult to distinguish the legitimate trades from the murky ones. However, Remco Lenterman says he can't understand why any firm would use a strategy like quote stuffing.
From an economic perspective, we can't even really figure out what would be the benefit of it. We certainly haven't observed quote stuffing for abusive purposes.
So it's just bad programming, not malevolent programming.
Exactly right. We see probably sloppy quotes sometimes where we feel, well, is it really necessary to update a quote as frequently as that? But I think it's also being tackled. It's been brought in the realm of abusive because people don't understand it.
It's a blustery day in Paternoster Square just by St Paul's Cathedral in the centre of the City of London. I've come to the high-tech home of the London Stock Exchange, the market, though not the only one for British stocks and shares. I've come here to try and find out whether the exchange, which has been one of London's great institutions for more than 300 years, regards the robots, the algorithms embedded in computers as heroes or villains.
I think they've been the inescapable and logical consequence of regulatory changes.
Good or bad?
Well, some of these consequences have been unintended, but ultimately the decision was not made by the exchanges and should not be laid at their door.
Xavier Rollet is in charge at the London Stock Exchange. He took over in 2009 as the exchange was faced with an onslaught of competition from the new generation of electronic rivals.
One of the most visible major impact of HFT trading in the exchange environment has been what we call in our jargon atomization. Prior to 2007, the average transaction on the London Stock Exchange was a bit higher than £60,000. Today it's less than £3,000.
Amazing. Unlike the New York Stock Exchange, the London Stock Exchange seems to have regained the upper hand against its low-cost electronic competitors. Today it's responsible for about 70% of trading in UK shares, and of this only a fifth is done by high-frequency traders. By contrast, in America, high-frequency trading dominates and the traditional exchanges have been much more squeezed. Rollet says that he hasn't pandered to the high-frequency traders in the way that US exchanges have done, and that's helped the London Stock Exchange retain the loyalty of the big investment institutions. But he hasn't shunned the robots. About 50 high-frequency trading firms pay to accelerate their transactions by co-locating their computer servers next to the London Stock Exchanges at a secret location in central London. So presumably, the London Stock Exchange is as vulnerable to spoofing and price manipulation as the US markets. Rollet.
This practice, of course, is not condoned by regulators. It's manipulative. We have, through our technological design, some very accurate means. If we believe that there is misbehavior, we can analyze them, capture them immediately, and then report them to the authority. I have to say that the case of investigated wrongdoing, certainly in our markets in the last few years, have been very low. But we do review a very high number of potential malpractice. And I think participants, broker-dealers, HFTs know that. And the fact that we're watching preserves, I think, a high level of integrity in our markets.
The speed that people are able to achieve with computer-based trading allows them to generate a huge volume very quickly. And sometimes if people want to hide their intentions in that, frankly, for the regulator, it creates more of a problem trying to pick out from a vast amount of data trades that might potentially be abusive.
Martin Wheatley is in charge of overseeing UK financial markets at the newly created Financial Conduct Authority.
In a sense, it's a technological arms race. We are investing, and we continue to invest in more and more technology that allows us to rebuild and track what's going on in the market. But I think it would be wrong to make the link that said high-frequency trading is itself a form of market abuse. It's a way of manipulating the market for people who want to manipulate the market.
So what purpose does this arms race ultimately serve? Isn't there something wrong with an economic system in which hundreds of millions of dollars are spent on laying cables between money centres to speed up trading by microseconds when the British government can't find the money to upgrade roads and railways? Greg Woods of Deutsche Bank.
It can look like an arms race, and yes, you can say, is this a meaningful investment of time and technology? But it's a continuation of the evolution of the marketplaces. The markets have always been changing. If you go back to Nathan Rothschild getting information from the Battle of Waterloo by carrier pigeon, to then trade between the British pound and the US dollar, the currency pair is still called cable because people traded off of what came down the cable across the Atlantic. And as the marketplace gets faster and the dissemination of information becomes faster, so you need to react faster.
But some exchanges are questioning whether it's time to halt this evolution. A couple, EBS and Tradition, have done this by introducing speed limits and undermining the very reason for high-frequency traders to exist. So if the high-frequency traders withered and died, would we really be poorer? Dr. Paul Wilmot is a quantitative finance academic, and he's an arch skeptic of algorithmic trading.
It seems that the markets have become more like a casino where what the company actually is, what the company does, how successful it is, becomes unimportant compared with what has happened to the share price over the last few minutes. The problem is if something happens and it doesn't bounce back, if it has caused a crash from which prices don't fully recover, then okay, you've saved 2 cents, but then you've lost half your pension. So it's really a case of penny wise, pound foolish.
Surely, therefore, it's far more important to make sure we have the right investments, rather than agonising about whether we paid a fraction of a penny too much for a parcel of shares. That raises the question whether high-frequency trading is at best a fatuous activity and at worst a spur to excessive trading, which benefits those who carry out transactions, the owners of the high-frequency trading firms, but is of debatable value to the clients, the investors, you and me as savers in pension funds and life policies. And there's another thing, for those who remember the fate of the world in the film Terminator, when machines took control and enslaved us all. Too far-fetched? Not, according to Paul Wilmot.
Once humans are out of the picture, then all sorts of wonderful, chaotic things can potentially happen. The models are getting increasingly complex, and you're handing over responsibility for what happens in the markets to black boxes. And there comes a point where you don't really know what the black box is doing, why it is